Going to our final panel for before lunchtime, and this is quite an exciting panel, which is going to be led by one of our own, Sashi Jayatileke. I always get into trouble with how I say her surname, but Sashi is a senior director at IMCA, which is part of the World Climate Foundation. Ladies and gentlemen, we're starting a new panel, so let's take it outside, please, so that other people can start. Great, so let's go outside and then we start the next panel. Thank you. So yes, the next panel is quite an interesting one. It is Blended Finance in Practice, Lessons to Unlock Scalable Climate Investments. Sashi, take it away. You will introduce your panelists. Give her a warm hand of applause. Thank you.
Here. Okay, thank you. Maybe I'll invite my fellow panelists to also come up. Anne-Marie Chidzero, Veronica Nyhan Jones, Rebecca Mikula-Wright, and Lisa Sachs. Thank you. So thank you all for joining us today. I know it's been a busy week, and maybe you've already been hearing about blended finance and the role it plays in unlocking climate finance. We wanted to talk a little bit with some of my distinguished panelists, which I have to make a comment on that. It is one of the first I've been on that's all women related to finance. So, thank you, World Climate Foundation, for noting that. But we are going to get into some nitty-gritty challenges as well as looking at opportunities in where we have learned in our history where there's opportunities for both unlocking more private capital as well as examples of where we can learn on essentially making it a little streamlined and simpler, as sometimes blended finance can be complicated. So we'll look to define it, we'll look to identify some challenges and opportunities, as well as where there are ways that we can coordinate better. To give you a little background, I'm a Senior Director of the Investment Mobilization Collaboration Alliance. It's a secretariat housed at the World Climate Foundation. It's a Nordic-led partnership that was started in COP28 with the US government. And essentially, the goal is to make it a little bit easier for donors to understand where there are ways to work together to conduct due diligence, reduce the process of searching for origination of deals. So we do joint procurements for blended finance and helping each other learn together and conduct monitoring and evaluation. It was really designed to advance our industry around some of the perceived barriers there are in blended finance, along the lines that I just mentioned with market information gaps, donor fragmentation, and essentially just the fact that pipeline is hard to find, especially when you're looking in places where there haven't been as much in sectors like climate adaptation and nature-based solutions. But I'm really excited to dig in with my panelists today on opportunities where we've really seen growth and change, and hopefully work together on coming up with some ways forward for us and lessons learned. We may hopefully have time for question and answer, but we have only 35 minutes because I think we're running a little behind. So we'll try to be efficient. Maybe I'll start with the question on where I've heard a lot of people discuss the gap in scaling. Essentially, a lot of blended finance facilities have reached financial close at a pilot stage, and they demonstrate a proof of concept, but then it's hard to get it to catalyze into replication or scale. And I've heard the term standardization is required. From your experience, what would you say has been some of the primary barriers for scale? Maybe I'll start with you, Anne-Marie.
Great, thank you very much. So I'm the Chief Investment Officer for a fund that's called FSD Africa Investment. So FSD stands for Financial Sector Deepening. And we work closely with our colleagues in FSD Africa that are doing more the sort of market building work around deepening financial markets. And we're backed by the UK government FCDO, but also a number of foundations. So when we're looking at using our capital, because our capital's purpose is to really go in first to test some of the instruments and structures in our market that's going to unlock finance for a number of different sectors. It could be energy, natural capital, SMEs, et cetera, but it's really around building the financial system. And so when we look at how do we use our capital, because we can take on a lot of risk, we have a capital preservation mandate, we're asking ourselves the question, what are we trying to solve? In terms of the failure of the market system. So why isn't capital moving? Why isn't commercial capital moving? So what's the problem we're trying to solve? And I think that's very important when you think about how the blending is then designed. So you talked about need for standardization. Yes, that could be important, but I think we should be also conscious that not everything fits, it's not a fit for all. And so we have the luxury in our mandate to not have to do the same thing each time. So we have done, for example, just recently closed 2 funds, which were targeting pension capital, so African pension capital. And we spent a lot of time with the pension industry, in this case in Nigeria and in Ghana, trying to understand what is stopping them from backing 2 fund managers that we were working on. One was in an infrastructure, so climate infrastructure, well recognized, a good track record, been in the market for a while, ARM Harris, a fantastic team, and they're raising a fund to invest in climate infrastructure, and it's an equity fund. So pension funds hadn't done a lot of equity in infrastructure. The other one was a fund of funds, different sector. It was funding fund managers in the SME space. Now, when we spoke to the Nigerian pension funds around the infrastructure fund, it was, what is stopping you? So is it really the risk? Or is it the liquidity that you need? And basically, it was around the liquidity. So when we look at the blending, what we did is to say, okay, well, then how can we use our capital in order to address that liquidity problem? And so because of the nature, the strategy of the fund, the maturity of the assets that they were going to be investing in, it was possible to get liquidity during the J curve. So we were able to structure our capital in a way that the pension funds would get some dividend on a yearly basis as the fund manager goes through their equity curve. Now, this is the first of its kind. It's still early to see whether it's going to change behavior, so to your question on scale. But I think it's important that we test these types of solutions in order to draw on capital. But for the different investors that are pooling their capital together, everybody's going to have a different risk return mandate and purpose. I think it's important to understand that. And then there is going to be one player, and typically it's the DFIs, that are going to be structuring to kind of sort of push and get, crowd in that capital. In the case of Ghana, what we found was the pension funds, given that the African pension sector is heavily invested in treasury bills, they wanted an opportunity to diversify. So they were looking for alternatives. So when we came in, we also engaged with them, ran a number of workshops to understand their concern. And it was more about a comfort, right? So it wasn't the liquidity, it wasn't really downside protection, but it was comfort, right? We did do a double stack. So there is investors coming in at a junior, so kind of more of that equity risk, if you will. But their view was, this is the first one. We'd like you to come in, give us that protection, but we want to do the next one on our own. Yeah. So I think the question of scale is still out there. I don't think, I think in other cases we may have achieved scale, but it's still a question: are we really changing the market? Are we really using these blended structures to change the market? I think it's the jury's still out, but it does mean you've got to bring in not only the blending, but the sort of market building, capacity building, ecosystem work to kind of support growth. So again, I'm speaking specifically for the African continent because that's what we're focusing on.
thank you. That's
Yeah.
a very good point. Would anyone else like to comment on this question?
I guess I can just build on the scale piece. Sorry, jumping in.
We're already to talk scale.
I guess I run the Asia Investor Group on climate change and the Australia-New Zealand equivalent. And I guess for institutional investors who can't get access to sort of some of these smaller deals, and we want to see that aggregation and therefore sort of that scale. So I guess to the point that was just touched on, like, how do we shape the system to make them investable? How do we make these markets investable overall? So I think we're really starting to see a shift from institutional investors, led by sort of pension funds, insurers, and particularly sovereign funds, who I think play a really unique role, as we just heard, in really connecting into the domestic investor base and then bringing in international and potentially larger capital. And they're the ones that can kind of de-risk. So we're doing a lot of work in Asian markets about how to build the capacity of the domestic investors and working with international, and then working on the enabling policy environment and what are the policy signals that we need to work on, and engaging with regulators and policymakers to really unlock that particular market, and sort of seeing how that progresses. So, and I think we're seeing a global, sort of a bit of a global pivot to going, we need to address investing and how do we invest more in emerging and developing markets. And so there's, and addressing the sort of the perceived versus real challenges that institutional investors face. And so I think there's a greater collaborative opportunity to have more of these conversations together that I think's been potentially a bit limited down one end of the investment spectrum, necessarily so by EMDBs and so on. But I think we're starting to kind of bring more of those conversations together, and particularly with development of country platforms and so on, but can go into that a bit later.
No, thank you. I mean, we went from Africa to Asia. Maybe, Veronica, you could...
Lisa, do you mind if I jump in?
No, please.
And from a global perspective in your role at the World Bank.
Thank you so much. So I'm with the World Bank Group, and I just want to say one of the things that we have done for scaling and impact recently that not everybody knows is in January we integrated massive parts of the World Bank Group, so that big parts of the private sector and the public sector are now integrated. And there's not like a dollar commitment to it, but I think it's a really important structural shift that I hope you will all experience in the market as one attempt to, dare I say, simplify, maybe to consolidate partnership with us. And I think this is important because, in FY25, the World Bank Group delivered $50 billion of what I call development climate finance, because there is no climate finance without development. And the IFC, our private sector arm, delivered $24 billion in FY25. 1/3 of that was own account and 2/3 mobilization. So I think it's also a really strong focus for us, and this is where we need all of the partners around the table. So on the blended finance side, in FY25, IFC delivered $800 million of blended finance across 78 projects. But the reason that's important is because it catalyzed almost $3 billion from IFC's own account, and then another $3 billion from private and public institutions. So again, I think you're all looking to us to do a better job of scaling, and so I just want to put that out there. I think I'm going to give two examples, if that's all right, of how we're trying to do things better or differently, and look forward to hearing from you. One is to lean in more on equity. So we want to make sure that we're finding ways to provide more junior equity in projects. We have the Frontier Opportunities Fund, where we committed $100 million of our own earned income towards that, and have been able to mobilize with other partners. But what's really the most new is our originate to distribute model, which is a securitization model, taking pools of our own real sector, productive sector loans, securitizing them, and creating a new asset class so institutional investors can find this more accessible, more credible, and that we get to recycle our capital back into the market. So I'll stop there for now. Thanks.
Great, thank you. Lisa, did you?
Yeah,
Yeah.
I think one of the other.
Oh, wait, and we just reached $1 billion. Sorry, that's why it's so new, as of last week. Sorry, Lisa.
No, I was just going to add.
Looking at you, made me see dollars.
Yeah, exactly. No, I think another benefit, if I understand, of the consolidation also was the consolidation of the guarantee structures, which I think is another incredibly underused, very important feature of the blended finance. I really like what you said, Anne-Marie, about the imperative of understanding the specific issues that we're trying to address and using the right tools. I look at that not from what the finance market needs to come in, but what are the systems that we're trying to build or change, and what are the specific risks in those contexts. And that, I think, allows scale in a very different way. If you look at, the types of risks in, for instance, industrial decarbonization, not a random example because I just wrote on this a month ago, the risks are very specific in different contexts. But it is specific risks in different industrial decarbonization projects that could be pooled with a guarantee fund for industrial decarbonization or for cities level financing. Cities struggle to access finance even more than others do because they often need sovereign guarantees or others. So we've been proposing the idea of a cities guarantee fund. So when you understand the specific risks in different sectors, or actually let me give you one other example that I think is really critical. In energy systems, which are increasingly or necessarily cross-border energy systems with renewable energy. We're working in Southeast Asia right now, which needs to be an integrated energy system, multilateral energy system among 11 countries with very different market structures, fiscal systems. There's going to be different net positioning. What the role is of quote unquote blended products, which can look different, pooled risk, shared ownership, what that looks like in that context to enable a system to be financeable and to work with cost reallocation and to ensure that every part of the system is financeable. That will be specific to Southeast Asia, but the concept of it should be how we think about financing integrated energy systems. So I think about it from the idea of what are we trying to finance and understanding what makes that system financeable or what are the challenges we're trying to address, and then what types of tools, pooled risk, guarantee structures, which I really think we should be leaning into more, and it's great that the World Bank and IFC and MIGA are really consolidating that tool, and other models that can address those specific risks, but at scale relative to the system and structure.
Thank you. Maybe I'll switch it a little bit to ask around, so this push for standardization and this demand for simplification, is that then creating essentially a design flaw in which we are trying to make it optimized for the wrong variable for investors? Like, is it for investor convenience versus actual impact on the ground for climate and development? Do you feel, and have you experienced this oversimplification then as a result of this question around how do we get to scale?
Should I give it a go? So I think, and again, I'm going to talk from sort of the African capital allocator environment. I think, first of all, it's really important to partner or to engage with the right players around the table. So again, the blending is happening because you're either trying to attract new capital, so your securitization, structuring, or you're trying to drive a strategy into sectors that are not typically funded by private capital. So we actually, with the IFC, worked with Rand Merchant Bank around a water bond. So this was at their initiative. They said looked at the Rhino bond that the World Bank issued 4 years ago and said, we want to do more to invest in nature. And so that's a specific sector strategy. And after 2 years of working on structuring this bond, who should be the issuer? Should it be the World Bank? Could it be FSD Africa Investment? At the end of the day, it was first Rand who issued the bond under their DMT program. And then just engaging with finding the outcome-based funders, but then also this is a water bond, so you need a conservation agency. So TNC, the Nature Conservancy, was the entity that was actually doing this conservation work. And so if you're I think when you're standardizing, in a way, you've got to think about the different purposes of the blending. So in this particular case, there was a blending in the sense that you had an outcome-based payer. So basically, the investors in the bond get a coupon, and a percentage of that coupon goes to funding the conservation. When they achieve certain milestones on the conservation, the outcome-based payer pays, and then the bond holders get, some upside. And so now what we're trying to do is say, okay, we've done one. we're going to monitor and see how it works, but we have a bit of a prototype. So you can begin to look at standardizing for that particular instrument, but there's always going to be tweaks. So how do you apply this for restoration, right? You're always going to have to change the model. So again, it comes to what are we trying to achieve? What's the purpose of the funding? What's the capital we're creating? And what's the instrument? And each one, I mean, we're looking at securitization as well for renewable energy, secondary market. Because we're trying to move capital. And so do we really need to have a blending, or is it just sort of spending the time to structure it, anchoring it, and that will bring in the other capital? So I just think we need to be careful about thinking about what does standardization mean, because there's just so many ways in which we could pool capital to do different types of, for different types of purposes.
Can I just add one unexpected reflection to the water bond, which we think is so amazing?
Yeah.
Thank you. I'm so glad that you raised it. I've been to that water basin with RMB and with TNC, excuse me, and what we, in this room, we talk about like the financial structuring, and this is very important. But sometimes we don't link it to the development outcomes on the ground, which of course are related to the preservation of nature, but really why that preservation of nature becomes so central to the economic growth and development story is because the municipality needs that water, that all the farmers need that water, the miners need that water, and there isn't a good structure for them to collaborate together on its not only preservation, but its productive, healthy, and regenerative use. And so one of the things that I think is so exciting about the work that they've been doing, that you all are invested in, is they've actually trained local invasive species clearing NGOs, women-headed, helicopter-riding, tree-cutting, community-based, like conservationists who are very much making a profit out of this experience. And so a big part of it is thinking about how does this transaction then also feed SME development and make sure that, again, nature is being treated as a regenerative asset as opposed to something that needs to be fenced off from local people. And so I just wanted to really appreciate, and the fascinating story is that one of the women SME leaders who got this training to do this essential invasive species clearing from the helicopter, the training that she got from TNC and the banks was sufficient for her to call her bank and use her unusual high-skilled training to operate a helicopter to cut trees off of a mountainside as collateral to get a large enough loan to start her own business, which has now grown like 10 times. So it's just the rest of the story that we don't often get to hear or tell. And I think you raised the question about, is there a mismatch between like investor interest and outcome and impact? And I often think there is not, but it feels like there is because we don't tell the whole story. Yeah. So sorry, total extra story, but
I'm glad you told
it's fine.
Yes, because that's why we do it.
Yeah.
Thank you. No, I mean,
And because it also has good return.
Yeah, thank you. I think it's important that we don't get stuck on the design because that's what everyone wants to hear here in London. But let's be honest, the reason we're designing these things is for that purpose. And so
And those people vote.
they vote.
It's all connected.
Yes. Did you want to come in?
I just wanted to add to that an experience that we had with the Indonesian JETP kind of program that's and sort of the country platform that's been developed. Institutional investors kind of were sort of presented with, deal structures and so on, and apart from, and it wasn't really designed with institutional investors in the first place, which I think is sort of part of the problem. And then it was presented, yes, there were risk return hurdles that weren't met. That was sort of a problem, but also the lack of a just transition. Investors wanted to see what is your just transition plan for this particular project, and understanding that it couldn't be done without, the community buy-in, the impacts on jobs and workers and so on. And so that was that was really clear that not having that in place would be a barrier to institutional investors coming in. So, and that's with sort of state-owned enterprises and looking for them to go kind of coal to clean. And so there's certainly an increase in the activity around just transition and engaging in these deals and making sure that that's embedded, because we have to have the social license to operate. We know in some markets, we've certainly seen with my Australian hat on, we're seeing that lack of social license is preventing deals and actually cancelling deals in the end. You have like local opposition to wind farms, perhaps often through misinformation, but it reduces the deal size because of the consultation process, and in many cases it's led to actually deals being cancelled. And it's very hard to rebuild that trust once it's broken, whether it's through misinformation or not. So, designing deals and programs and having community buy-in at the outset is really critical. Otherwise, in the Australian context, it's been a real setback for some of the transition. And so learning those lessons and then bringing in these great case studies and examples. So we have to kind of tell the good and the lessons learned as we sort of start to do more of these deals and bring the community in, so that, because they're getting the benefits. They're the ones doing the work, they're getting the jobs, and then, they're voting. So, connecting all those pieces with policymakers is really important.
So there's a reason why blended finance takes time, essentially. You have to do the analytical work, you have to ensure there's community participation, and you have to set the systems in place to be able to ensure the success. Something I've heard a lot about, and I think has been growing interest because of the cuts in ODA, is that there's a lot more demand for first loss when it comes to blended finance structures. And I have this sense that some private investors just feel like it's an easy choice for donors to come up and just issue first loss versus other types of instruments. And I know, Anne-Marie, you honed in on this point of understand what the barriers are first and then choose the instrument based on the context. But there is a perception that, first loss is the most demanded and yet hardest to find. And also when you combine that with challenges in adaptation, not getting much funding in climate, where have you seen experience on how to make that decision of when first loss might be needed or how it could be best deployed?
I think, just to link this back to your last question, I think we have the simplicity and the complexity reversed in practice. The structures from the investor side are often very complex, very bespoke, hard to get out, illiquid, and then on the design side, pretty blunt. And we are not very thoughtful about what the right structure is for the deployment. And so, but the experiences that you've spoken to speak to the opposite, which is really understand the context, and whether that's whether you described incredibly interesting watershed type projects. For me, was integrated energy system or industrial decarbonization. The expertise and the thoughtfulness and the complexity should be on the side that people knowing what problem you're solving and what are you actually trying to structure on the ground, but then make it easy for the investors. It should be the other way around. I think the idea of first loss is asking the market what makes more sense rather than actually starting with what makes more sense in terms of deployment. But the point should be that the investors want something that is easy for them, and I think that part is right. I think one way to address that is underused is aggregation in general. One of the challenges, let me put it that way, with the donors and with others is a reluctance to pool the sources of public capital in blended finance because of all the reasons that one might expect. But it does mean that every type of guarantee has different structures. That makes it hard. Whereas if we could aggregate by the type of output we're looking for and have the donors feed into some common pool that would allow for liquidity, that would allow for easy entry and exit for the investors, I think that's the easiest way to get the technical rigor and understanding the complexity of the deployment of the design, but the ease of access for the institutional investors.
I should say on that point, that's the whole purpose of IMCA. That's what it was started for, was essentially getting 6 governments together to say this is not working. The JETP process was incredibly challenging in 2021, and the Nordic governments came along with the US government, and now we have observers from Canada, the UK, Netherlands, essentially participating in these joint pooled calls for proposals. And we've issued 4 windows. The 4th is in place right now, focused on adaptation finance in Africa. And it's essentially to reduce the transaction cost of sourcing and managing. But the bureaucracy process is not easy. Anyone else want to comment on first law?
Well, I might just add, because Lisa, you so nicely teed up the MIGA Guarantees Program, which I love hearing it from somebody else because it's so much better than hearing it from me. But in case you don't know, part of that consolidation was we have now a World Bank Group guarantee platform housed in MIGA, the Multilateral Insurance Guarantee Agency. And essentially, it is intended to use both the World Bank and IFC balance sheets and then offer simplified application processes. And then ultimately, after, the World Bank or IFC is vested for 5 years, because our investees and partners count us to be long-term, after 5 years, MIGA can take that to the private sector and enable us to again recycle our capital. But I think it's the simplification process that people are looking for. And just on your point of the JETPs and Indonesia, I think one of the things we heard maybe together in Indonesia, in Singapore recently, is how one of the major hurdles for the JETP in Indonesia to be successful faster was government procurement processes and a lack of trust and confidence from, programs that would apply. And so I think it just comes back to, we design these structures, and then sometimes we forget that all the different users that need to feel vested and trust in the process.
Yeah. Before I came to IMCA, I spent my career at USAID working on local market development. And so I was there with the Indonesian government when they were discussing this. And the only way they were willing
You've seen the whole journey.
I've seen the whole journey. They came to the table, but they had USAID behind them, helping them negotiate what was best in terms of the transition, because you can't just assume that going from coal to renewable can happen like that. Not to mention other geopolitical forces. But the last question is related to this, local market development, and the need to consider additionality when we bring in investment from either foreign investment or even if it's institutional investment regionally. How do you ensure that blended finance is not poorly calibrated? I think you've already touched a little bit on this, but and really the larger goal is local market development and financial systems. Where have you seen this happen, and how can we ensure that it's durable and that we're not distorting markets with blended finance?
And I think one thing that I find very challenging but so important is how little broader systems and structures are understood by others. And a lot, so in what enables finance to flow, a lot is determined by international financial architecture and rules and structures that won't and shouldn't be solved by blended finance, but that need to be solved. This is not climate specific. This has been what's limiting finance to developing countries for an eternity. And it's urgent to solve. So I think one thing is not to conflate blended finance as the solution, but to understand what the structural determinants are. And I think the major structural determinants of local market development are those institutional structures that limit the ability to borrow long-term affordably to invest in the productive economy and so on. That would be one thing. On the blended finance side, I like Veronica, your point on exit, because it should be a way to de-risk something with the view to exit. And I don't think we think of it all the time that way. It's being used pretty bluntly, but the way it should be thinking of what is the minimum risk, what is the risk that is misperceived, or a risk of a getting over a hump of a first of a kind technology or something that is a way to build confidence. And then that should allow us to think when we're using it and what and how we design it to be used. But it's not how we're frequently using it. We're using it in structures that are never suitable for private sector finance. So they're going to be like that forever because we don't think about the appropriate role of public finance and so on. So and then maybe one last point is that for development finance institutions, and I think this is a challenge that again has structural determinants, but the leverage or the ability to get the incentives are not really to have maximum leverage with minimum. The development banks don't have the same standardized treatment of guarantees actually, and so sometimes they're treated the same as direct outlays. So the incentives are not really in place to think about how you can have the biggest leverage for the smallest thing. So I think that there are a lot of structural aspects that take understanding the systems, the institutions, and the other structural determinants that are useful for answering that question.
Can I just sort of add, again, from a market building perspective and making sure that you continue to have additionality and that you're now not crowding out that capital. I think it's just so critically important to be very, very intentional about why you're making the investment from that domestic capital mobilization perspective. So, our investment committees are very rigorously challenging us. Why do they need our capital? Why are you participating, and what are you unlocking? And what are you putting into the market that actually is going to be useful to change the behavior of the financial system? So I think the investment committee questions are critically important to keep focus on the purpose of this scarce. And I don't like to call it first loss. To me, it's more like the equity risk. So just to keep us, honest about what are we really trying to drive, and to be asking that question: what's the market building element? And I know, for example, BII is really pushing that now. I said on one of their investment committees, about every investment you make, you really got to unpack what's the market building. And it depends. I mean, there's different sectors. But what is that market building angle? So I think it's that intentionality that's important.
Thank you. Any other?
I would love to add one thing, but I wanted to let you come in.
I guess from the institutional perspective, I guess it's sort of the more top-down aspect. So, the blended finance structures and first of a kind and proof of concept and so on are important and necessary. But we're sort of saying, right, what will unlock more of those at scale? So, and where can institutional capital actually have access, and where there's increasing demand for that? And that's in, transmission, grids, storage, so it's like, great, how do we, if, there's no point doing a cold clean if you don't have the grid and transmission infrastructure to, and then the plan for the solar rollout. So we're kind of looking at the bigger system and how do we enable that and unlock that so that you can actually deploy more renewables and then gradually shut down the coal. So kind of potentially looking at it from the other perspective and engaging with policymakers and getting government level coordination so that they can see it's like we're trying to sort of support the system change here, which can then bring all these deals together, help aggregate them. But if we don't think about it with the end goal in mind, then they're going to fail and come up against barriers that we've seen. So kind of how do we just do that top-down level? And it takes longer, obviously, but it's important. And I think we know, taking from the lessons learned and how do we speed up the process.
Yeah. Aggregation has come up a number of times, pooled capital. We have time for final remarks, so maybe I'll turn to you, Veronica.
Thank you. I'm so sparked by my colleagues here. I just wanted to add on Lisa, your point about, what I'm hearing is not only does our exit through guarantees enable us to recycle our capital, which is precious and needs to be used intentionally, but also that's where we can start shifting into local currencies, because very often that guarantee is provided with a local or regional bank, and that is game-changing for the local economy. And as we all know, ODA is shrinking. Not only is ODA shrinking, but the existing ODA, it's like 2%, at least we'll know the exact number, that can even be used for private capital mobilization. I mean, we say that that's what we want, but it's not, I'm not sure, who on the boards is here today, but I think that's something we really need to consider. On the local capital market building that then can take advantage of, these local banks coming in, we do a lot of capacity building of financial institutions and real sector to help them understand the opportunity of the $1 trillion labeled finance market. And very often we do like peer-to-peer, south-to-south training, but helping them to understand what is required to be eligible to label something. What are the incentives? What is too onerous and should not be considered for their local bank to come in? And then how can they start to be like a beacon of local capital market building in their country, because very often they'll go on to issue first of kind, social linked or sustainability linked bonds, and intentionally thinking about how does that create a ripple effect for access for SMEs and other businesses, particularly in the greener spaces. So, we trained a bunch of local banking leaders who also, what's lovely is you train individuals, they become champions even when they leave their banks, actually very often after after we all spend time together, they get poached or promoted, but they stay in the industry. So there's no brain drain really. And then they've gone on to issue over $20 billion of sustainable finance in emerging markets, and typically first of kind in their country. So I think we often don't think enough. We talk so much about ODA and so much about very sophisticated investors, but really I think the future is developing local capital markets. And so when we can be helping to build that capacity, and as you mentioned, perceived risk, Lisa, very often their cost of capital is just irrationally high, and a lot of that is people. That is people making decisions at their desk every day. So we can all be a part of that solution here. Thanks.
Thank you. Any other final remarks? We're at time, but if not, I want to say thank you to everybody for your avid conversation. It was really fun hearing your perspectives, and I wish we had more time to have a Q&A, but hopefully this is the start of the conversation. So thank you all.
Great, great, great. And all ladies panel, fantastic, well done.